What is up, everyone? So in this video I'm going to show you guys why I think the housing market in Australia and Canada could be set to burst and how you can profit from it. And before we go any further, make sure you hit the like button and subscribe.
Do it! Just do it!
So as many of you know, one of the primary drivers of the economic crisis back in 2008 was due to subprime mortgage debt, hence the name the subprime mortgage crisis. And this was caused by many things such as years of easy credit, frivolous lending, people that could not back it up. People would have multiple mortgages taken out, trying to speculate, thinking that housing prices would keep going up and up and up forever. And a lot of these people had very low income levels.
James probably is wrong.
200% on all my loans?
What do you mean all your loans? We're talking about 2 loans on 1 house, right?
I have 5 houses and a condo.
And that's just a great depiction of who these banks were actually lending to and just how out of hand it had gotten. We all know what happened shortly thereafter. We had one of the worst recessions since the Great Depression, and basically central bankers had to print their way out of it. Like 10 years later, I do think the US economy and banks are much healthier, and we're much more able to withstand a recession than what we were 10 years ago. But that's not necessarily the case in some other countries around the world. Many data points that I follow that show the health of the consumer, the health of the housing market in a country, and household debt to disposable income is one of the main ones that I look at. And this really just goes to show how stressed the consumer is in Australia and Canada. Australia has household debt to disposable income of 190%. Canada has household debt to disposable income of 170%. And to put that into context, back in 2008, that looked like 130% for the US debt to disposable income. So that really just goes to show how stressed the consumer is in those countries. And let's just take a second to think about this statistic for a while. So it's household debt to disposable income. And how that's calculated is taking households' debts, so that could be credit cards, student loans, car loans, but the main one is mortgage debt. So you take the monthly or yearly debt and divide it by the monthly or yearly income. So that means in Australia, 190% consumers have almost twice as much debt as what they're making in income.
What?
And that's just mind-boggling to me that consumers have twice as much debt as what they're making. This is not healthy and this is not sustainable whatsoever. The boom of the Australia economy and housing market there, that can really be credited a lot to the growth of China over the last few decades. Australia's economy is heavily based towards mining. They have a lot of natural resources that they export to China. So if China ever, has a recession, or they're very much on the verge of having a recession, and they're slowing greatly the last couple years. And this could also have a very big impact on Australia's economy and their housing market. A lot of their housing market has been fueled by China investment and speculation in their housing markets. They also have a visa to where if foreigners, mainly from China, invest so much in their property markets, they basically get citizenship there. So that has been a big part of what's fueled the housing boom there. But things are changing very quickly. China has been slowing very quickly. This can be credited to tariffs from the US, but even before that they were slowing. And this has just kind of sped up that process. And a lot of people have been saying that the housing market has been overvalued for years now. There's been a lot of people that have been trying to call the top in the housing markets, and it's really been the widowmaker trade because the bubble has not burst. What makes this finally burst? Who knows? I think it could very well be the fact that China is slowing down that could finally make this burst. Also, Australia has been raising mortgage rates, and that just makes it that much more that Australia consumers have to pay on their loans. So these things combined, I think this could be finally what makes the bubble burst. And once people can't start making those payments that the banks are lending out to them, obviously that's going to negatively impact the banks. Like I said, just back in 2008, almost every bank in the US almost went under, and they would have went under if it weren't for the U.S. taxpayer that bailed them out. So, you know, I could see this very well happening in Australia and Canada. Already the banks are under quite a bit of pressure, but really we haven't seen like a all-out, you know, meltdown of the housing market in those countries. You know, like I said, I think we're getting close to that point, but it's really just a waiting game now to see what actually makes that bubble burst. Now we'll go and jump into my computer and I'll show you guys a couple different products that you can use to short Australia and Canada banks. All right, so like I said before, we've already singled out that this will have the biggest impact on banks in these two countries. So we'll go and cover some of the banks in Australia here. So if you live in the US, you can't actually trade options on the banks. Westpac Banking Corp, that's one of the biggest banks in Australia. You can short this. However, there are no options available on this, which is how I like to play shorting these banks, because they do have fairly substantial dividends. Westpac has 7% dividend yield, and when you actually short a stock, you actually have to pay the dividends, because when you're shorting, you're borrowing shares, so you actually have to pay that dividend back. So how I like to play this is with options. Like I said, you can't actually short or buy options on Australia banks if you live in the US. I'm not sure if you're from Australia, if they have options on these banks, but I just know that in the US they're not available. So one way that I like to play this and have been playing this is with just an ETF that covers Australia in general. And this is heavily weighted towards banks. As you can see here, top 10 holdings in this ETF, 12% or sorry, 9% to Commonwealth Bank, Westpac Bank 6%, another bank, Australia New Zealand Banking Group 6%, National Australia Bank 5%. So this is heavily weighted towards banks, as well as BHP Group. I believe that's mining company, and Rio Tinto, that's mining. So like I said, obviously if anything happens, slow down, that's already happening in China, mining is going to be another one that is going to be impacted heavily. So that's how I like to play the shorts Australia housings, is through this ETF, because you can purchase options through here. You know, I've been going out to July for mine. And another way that you could play shorts Australia is to actually short their currency. So AUD, USD. I mean, just look at that. Just look at that.
Look at this. Oh, look at this. Oh, would you look at this?
And as you can see, really in the last year, it's already gone down quite a bit. Just look at that. It's kind of crazy. 2-year had a high of 80 cents to 1 USD. But you know, this could be another way that you could play the short Australia and short Australia housing, is to short their currency to the US dollar. The dollar's been very strong, but I don't see this getting any better just with, you know, the situation over there with the banks. And so now we'll go to some of the banks in Canada. So we have TD Bank, and the good thing about Canada is we can buy options with this. I have puts in TD Bank. I have the July 55 puts, and as you can see, had a high around 62. Back when the market melted down, it went all the way down to 47, and it's rallied back nicely here. And I bought puts in here, and like I said, they go out till July, so I have quite a bit of time for these to play out. There's a chance I might add some more. Some of the other banks here, and I'll zoom out here actually real quick. Go to 3-year. As you can see, back in 08, had a low of 13. Obviously, it's not going to go. I'm not predicting like a full-on meltdown in these countries. It very well could happen, but we don't necessarily need a meltdown to make that much money with these. So we have TD, we have BNS, Bank of Nova Scotia. Let's see, I have a watch list here. We have BMO, Bank of Montreal. We have CM, Canada Imperial Bank. And all these have options that you can trade. So just buying puts. That's how I am playing the short Canada housing play, is just shorting these banks and buying puts. I think that's the easiest and lowest risk way to do it. And if you just flip it around, I don't see much upside to the banks. So I don't see any downside in this. And even if housing doesn't burst, with options, the most that you can lose is the premium that you pay for the option. So say you buy like $1,000 worth of puts, July, going out to July like I have. The most that you can lose, so say like TD, that's what I bought 55 put. Say it doesn't go down below 55. The most that you can lose is $1,000, which would suck, but it's not like Forex, that's quite a bit more leveraged. So obviously you can lose more money with that. It's just like Forex futures, those two things, you can lose a lot more money just because it's more leveraged. The nice thing with options is the most that you can lose is the amount that you paid for the options. And potential upside is technically unlimited. All right, that's it for this video, guys. I hope you guys enjoyed. Another quick point that I want to make is it's going to be important to watch what happens with the trade deal between US and China. That's what the market's been really looking at the last month or so, or even longer than that, but that's part of the reason why it's rallied back so much, is the optimism around the trade deal. And if we don't come to a deal with China, that's going to have a very negative impact toward obviously China, but more so Australia, because their economy, like I said, is very influenced by China and what they import from them commodity-wise. So that's going to be a very big thing to watch. And even if we do get a trade deal with China, I don't think that's going to really help out much. It's really priced in a lot in the markets that we're going to get some sort of deal. But I don't think that's going to help out the fact that a lot of the economies around the world are starting to slow very quickly. I pointed this out in my last video, so if you haven't already, go watch my last video where I give my outlook on the stock market for the rest of 2019. I'll link that down below. So yeah, that's it for this video, guys. Thanks for watching, and I'll see you guys in the next one.